executed at that price.
Yeah.
So what would have happened? Let's assume in case that order was filled by a market order, whether there would have been a profit or a loss. And, that's the underlying data based on which some quantification has been done. If I were to.
Yeah.
My only question to Prachi is,
yes.
I mean, I saw in the paper that you guys are defining what a limit order is and a market order is based on this ask price. If he's willing to buy above the ask price, but exchanges usually give you limit orders and market orders. Right?
Yeah. So this data did not have that tag.
Okay.
But essentially, so basically every order comes with it's like a limit price in that setting. So essentially, if it's like a marketable limit order or like a limit order.
Yeah.
So I'm calling it market order, but it's really a marketable limit order. So essentially, if the price is such that you're willing to when you're buying, you're willing to pay the ask price, then it will get executed immediately. And so then that is what we are calling a market order.
So this is also something interesting. So we don't have the concept of a marketable limit order here in our exchange.
Yeah.
Correct.
Pradeep was telling us also about the same thing.
Right.
I think it's fairly common outside. We have limit orders and market orders, but there are marketable limit orders as well.
Correct.
What portion of the limit order will immediately go through?
Yeah.
Isn't it?
Yeah. And so for, all practical purposes, marketable limit orders essentially are market orders because, their, price is at like current order book, they will get executed because they're willing to pay for buying, they're willing to pay a price at ask or higher, and for selling, they're willing to accept a price at bid or lower. So they are effectively marketable, and I don't remember exact percentage, but I think 99.9 or 99.5% of the marketable limit orders get executed fully immediately.
Acha. Okay. No, because on our systems, market orders are very few. Limit orders are far more. But if you include marketable limit orders, then it's a different story.
Correct.
But if this is the way it is defined, it is practically like a market order. Though I'm not clear as to what is that 0.5 that didn't get executed.
So it could be that there is not enough depth at the best ask. And best bid. It could be that the quantity of the order is larger than the depth at best ask or best bid. And then that's why it did not get fully executed.
So that touch line was not good enough. As we call it the touch line. The first line of the MBP, the market buy price, is the touch line. And your order was bigger than what the touch line had to offer.
Right.
Oh, yeah. Got it. So when do we sort of start?
I don't know if is Anand the ring master here?
Anand is the ring master.
Hi.
Hi.
Hello, sir. No, so I think we are at time. It's totally up to you.
Yeah.
We can give it probably. I think we can start. We'll get through the introductions.
Could we give it
and
1 or 2 minutes just for some people to join in if you would like?
Sure.
I think let's wait for a couple of minutes and then we can start. Okay. Yeah. Anand, my ISB logo is like the right side, right?
It's perfect.
Okay, because I always get disoriented on Zoom. For me it's showing the mirror image. So
right.
But I'm told that if it is mirror image for me, then it's looking fine for other people.
Yeah.
Yes. You're absolutely right.
Oh yeah, this is the mirror image actually.
Do you see the mirror? Like ISB logo? You see the mirror image? Or you're seeing can you read like ISB as it is?
We can read ISB.
Okay. Yeah.
Let's find. So such analysis have been done across, say, Indian markets as well?
Not that I know of. But such detailed data, of course, is also available in our markets, and it's possible to do it. So just that, it has not been done.
Prachi, one conversation I remember, I think you were saying that not all the research has to be forefront. Some of it could also be done when just to understand how similar similar phenomena are seen in our markets. So, something like this could very well be done for Indian markets.
Yeah, absolutely. And I think this is particularly relevant now, given that we have seen, such increase in individual participants in the markets last 2 years, right? So all these things that are relevant for individual investor behavior have become even more important. So absolutely.
I think, that's one point I'm going to ask you. Why not do this analysis on Indian markets? And what do you think?
Okay, I'll put it back to you then, Tirthankar. happy to do it. if we collaborate and if NSE provides the right data.
No, I think it should be possible. This should
absolutely.
Definitely be an interesting sort of idea. In fact, in general, it could be a very good idea to look at regret or measure regret around regulatory moves.
Right.
Part of regulatory impact assessment, it will be a very good idea. What happens with individual choice, investor choice?
Anand,
yes.
Should we start?
Yes, I was just going to mention, sir. I think we can start now.
Yeah.
Okay. Just give me a moment. Yes. So, Anand, ready when you are. Good evening, everyone.
Good to go.
Good evening, everyone. Thank you for joining us for today's NSE ISB webinar on how regret affects investor behavior. Research in behavioral economics has gained considerable interest in recent times, while traditional theories as the efficient market hypothesis state that stock markets are efficient because stock prices reflect all available information. Behavioral finance suggests that market participants are not perfectly rational, and psychological and social factors do influence their investing decisions. Today's webinar is being organized under the aegis of the NSE ISB Trading Lab, where we're going to discuss some interesting insights from Professor Prachi Deuskar's research in this topic. The Trading Lab is a joint initiative by the NSE and ISB that was set up in 2014 with the aim to pursue research and promote policy dialogue in the area of securities trading, investments, and broadly the financial markets. The Trading Lab has made significant progress in unexplored research avenues in capital markets, corporate finance, asset pricing, etc., with a larger focus on the Indian financial markets. The Trading Lab has produced several high quality and insightful research papers, some of which have been published in reputed international journals, such as the RFS, that's the Review of Financial Studies, the Review of Finance, the Journal of Money, Credit and Banking, the Journal of Accounting Research, the Journal of Financial and Quantitative Analysis, and Management Science. I would now invite Mr. K. Somasundaram, our Chief Enterprise Risk Officer of the National Stock Exchange, to deliver the welcome address and start today's session. Over to you, Som.
Hi, good evening to one and all. On behalf of NSE, I extend a warm welcome to Professor Prachi Deuskar for accepting our invitation to share her thoughts and research findings with us on this topic. Indian equity markets have outperformed global benchmark indices in the last 2 years, thanks to a supportive fiscal and monetary policies and a resilient economic environment. The key highlight during this period has been the exponential rise in retail participation in the equity markets in terms of both the share of trading activity as well as the net investments, which has touched 45% and rupees 665 billion respectively in the financial year 2021 in NSE's capital market segment. While the share of retail participation in the overall trading activity has come off marginally from 45% to 41% in FY22 and then to 37% in the current fiscal, the net investment by retail investors has continued to remain buoyant, crossing the 2 trillion rupee mark during this period. The surge in retail investments has captivated the interest of financial market researchers, practitioners, and policymakers, giving a boost to the studies in the area of behavioral finance. The underlying motivation of such studies is to understand trading behavior of investors during different phases of market movements and the psychological factors that influence the decision-making and trading strategies. Such empirical studies provide very useful insights for policy intervention, market surveillance, and market development as they use cognitive sciences to explain market. NSE endeavors to encourage initiatives on relevant and emerging issues in financial markets domain that are beneficial in creating financial awareness amongst investors and promoting policy dialogues amongst regulators that strengthens the overall market integrity. Notably, NSE's extensive investor education and awareness programs across large and small districts of the country have contributed significantly to enhance the financial literacy in the country, improve the retail penetration in financial markets, and help investors achieve financial freedom and well-being. NSE's research initiatives span across diverse fields of finance, such as corporate governance, empirical finance, securities markets, and market microstructure, amongst others. The insights from these research initiatives are widely discussed and disseminated via panel discussion on conferences, lecture series, and NSE publications in the public domain. The overarching theme of today's webinar is to understand the effect of regret on trading behavior amongst investors. We are honored to have amongst us Professor Prachi Deuskar, who has the experience of extensive research in financial market domain. On behalf of NSE, once again, I welcome you all to this webinar and hope you will find insightful and useful takeaways from today's deliberations. Thank you.
Thank you. Thank you so much. Now, let me before we begin the webinar, let me just introduce our speaker for the day. So, Professor Prachi Deuskar, our guest speaker, is the assistant professor of finance at the Indian School of Business. Her research interests include market frictions, liquidity, asset pricing, and behavioral finance. She teaches corporate finance, portfolio management, and asset liability management, among others. She has also taught at the College of Business at the University of Illinois at Urbana-Champaign. Professor Deuskar is a PhD from NYU Stern and an MBA from IIM Bangalore. In the research paper being discussed today, Professor Deuskar and her co-authors use a data set from the Chinese stock markets to quantify the actual effect regret, yeah, you heard that right, regret has upon investor stock trading behavior, and how experienced regret of past trading strategies affects the subsequent strategies of investors. So Prachi, over to you. How should we do it, Prachi? Should I just start with questions, or should you want to present something earlier, or
we can I can just give a 2-minute overview and the motivation, and then I think question answer format would work best.
Please,
so
go ahead, please.
Okay, yeah. Thank you so much, Mr. Somsundaram and Dr. Tirthankar and NSE ISB Trading Lab for inviting me to talk about this research. And I find this research fascinating. Of course, I have worked on it, so that is the reason I worked on it. But the one more reason why it is very interesting is while there is kind of increasing research on effect of investor psychology on their trading behavior and outcomes of their trading behavior, this whole area of behavioral finance, it is very difficult to actually quantify regret in a real world setting like the financial markets, right? And so this is what we were talking about earlier. And in this setting, we were able to quantify regret experienced by an individual investor and then see how it plays out in their future behavior, right? And the regret as an emotion is very important. Research in psychology has found that regret is, the second most commonly cited emotion, next only to love, right? And so we thought that it's important, since people think about regret, feel regret all the time. It's important to see how that affects trading behavior. This is from the financial market side, but also from overall research on regret across different areas. There has been a lot of work that is theoretical modeling. There also has been a lot of work that is in the labs, that is experimental work, but not much work examining effect of regret in a real world setting. So because of both these things, we thought it's an important question to ask. And luckily, we had the data that allowed us to answer this question.
Swati, sorry, Prachi, apologies. It is an emotion that I think most of us are very familiar with. Most of us, when we trade, we either feel exuberance or regret, and of course in degrees, depending on how large or how good or how bad our trading decision is. Now, how do you quantify such an emotion?
Yeah, and that's one of the most important questions. So kind of just stepping back before I go into the details of our setup, right? What is regret really, right? So we feel regret when we take one decision and then that decision plays out, but then we feel or we realize that if we had behaved differently, then the outcome would have been better, right? So regret is, not just disappointment, not just sorrow, but it's in some sense, it's like guilt or, feeling that I could have done something different that would have resulted in a better outcome. Okay. And exactly for this reason, in a real world setting, for a researcher, it's very hard to observe what is the regret felt by a particular individual, right? Only we ourselves know what is our regret. So we don't know regret actually felt by the investor, but we can figure out what decisions they actually made and what decisions they could have made. And we can actually also track both those decisions, and essentially the difference between those two decisions is our measure of regret. Right? So let me give little bit more details so that it's clear. And Tirthankar, please stop me to clarify anything at any point. Right. So the specific setting we use in this research is whether the investor has placed a market order or a limit order. So we are going to examine the decision along this dimension, and we have intraday data on all the orders that a particular all the individuals place, and we also have the intraday price trajectory of that particular stock, right? So let's say, for example, Dr. Tirthankar placed a market order to buy Infosys, and then the order was executed. He bought Infosys shares, and then after that, Infosys price went down, and he made a loss on his purchase. Right? Now let's see. So this is what actually happened. Okay. But now let's imagine what would have happened if he had placed a different type of order, that is limit order. Okay. And then let's say if he placed a limit order, and let's say that limit order, was not executed. Okay. And then he would have avoided the loss that he actually made. Okay. And so sort of, zero profit on what could have happened versus negative profit on what actually happened, right? So that is difference between that is how we measure regret. Essentially return on the decision actually made versus return on the decision that could have been made.
Okay, and this is essentially done across retail investors over a period of time.
Yes, yes. So our data allows us to track each retail investors through time. So we exactly know what decisions they made the last time they placed an order, what decision they made this time, and so on throughout our sample period. And we observe their behavior in like all the stocks in which they trade.
So I have a few questions on the calibration of the data itself.
Yeah.
Before I go into the broader points. So suppose the decision, and just for our audience, you've segregated market orders and limit orders, and you basically said that where market orders, there's no price decision being taken. There's the decision to buy or sell, independent of what the price is, and then where there's a limit order, there is a you want your order to go in only at a particular price, and then you realize that what did happen versus what could have happened. Now, Prachi, my question is, when we measure what could have happened, it would obviously be at a point in future. So, how do we sort of, in this analysis of yours on the Chinese stock markets, how do we define future? So, do you measure the outcome immediately, or after a few minutes, or 10 minutes, or how does that happen?
Yeah. So essentially, our objective of measuring regret, first of all, is see how it affects the next decision. Okay, and so what we do is the future is still like the next decision is made, or like flipping the perspective, we can say, okay, the investor is making a decision right now. Okay, let's look at her most recent decision before this. Okay, and then we measure regret of the previous decision till the current order. So basically previous order till current order. And essentially that is when we say, okay, this is the regret they have experienced till this point. Now they are placing an order, and now let's see, if they change their behavior based on the regret.
That's a very smart way of looking at it, actually. So what is the time period of this analysis, and how many individuals are we talking?
So the time period is 1 year. This is actually a little bit older sample period. This is 2004 to 2005. But like Indian stock markets, Chinese stock markets also have a lot of retail presence compared to like say US or European markets, which is much more institutional compared to the Asian markets, right? So this is the period, and overall we have several million retail investors, and like more than 100 million orders that they have placed.
Okay. So yeah, we are looking at all orders, isn't
all orders, whether or not they were executed.
Okay. And so over a year of data, and then you have several million investors, and then you have over 100 million orders. So
yeah,
fairly extensive analysis there.
Yes. And this is what kind of allows us to answer this question conclusively, because I mean, we as a person, as an individual, we can tell for sure whether we experience regret and whether we want to change our behavior, right? But as an outsider, as a researcher, to kind of see patterns, whether regret systematically affects behavior, we need to have a lot of individual investors, because it should not be the case that just behavior of like just few outlier investors affect our conclusion.
Of course. Again, so we can go in like two directions here. I just wanted to put a broader question at this point. the analysis of regret theory and so forth is could be described, and correct me if I'm wrong, as part of investor psychology, how you're studying investor psychology.
Correct.
So can you just give us some idea about what kind of work has been done on investor psychology?
Yes.
And where does your work sort of fit in?
Absolutely. Okay. And so in last maybe 2 to 3 decades, there has been lot of work on investor psychology in different ways, right? Some of it is just trying to quantify what we call investor sentiment, that is essentially irrational optimism or pessimism of investors, and then kind of examine its impact on like future stock returns. So that's kind of one strand of literature, right? The second strand of literature is kind of looking more closely at investor behavior, that is whether they herd or when they are likely to herd, or that a certain tendency that is called disposition effects, that is investors want to not sell their losing stocks, hold on to their losing stocks, and then kind of sell their winning stocks to kind of realize profit. So there has been a lot of work on this tendency by investors, right? There also has been work on how experience affects investor behavior, right? And so there's been some fascinating work in the US context, looking at people who grew up during the Great Depression, how in future their financial decisions are shaped by their experiences. And so it turns out that they are much more risk averse given their experiences. And so there has kind of been this body of work that looks at investor behavior affected by things other than rational factors, right? Because as you mentioned in the introduction, traditionally investing or financial markets was considered as a very sort of rational and efficient territory. But we now increasingly realize these are decisions made by humans, and so human emotion kind of does play a role. And so our kind of research fits into this. It is in some way it is similar to documenting effect of experience on future behavior, but we are trying to go sort of one step finer. We're actually trying to say that, okay, this emotion is regret, and then this is how regret affects behavior. The other part of our paper, which we will come to, where we also examine whether the decisions affected by regret do well or do poorly. And there's also work on that, showing that emotional decisions that investors take, and this can be individual investors or professional investors. This has been shown for professional investors as well, that emotionally charged decisions tend to be worse decisions.
So how do we sort of segregate or determine whether this change in investor strategy, which happens after regret,
correct
due to regret, or is it due to fundamentally market action?
Yeah. No, excellent question. Okay. So just to give like a 2-sentence summary of our main results, right? What we find, I described how we measure regret, right? And what we essentially find is, if an investor is experiencing regret, then she will flip her decision. So essentially, if she placed a market order, then next decision will be limit order, and vice versa, right? And now Dr. Tirthankar is asking, but there could be many reasons why somebody changes from market order to limit order, or vice versa, right? How do we know that this is actually because of regret and not because of something else? right? And this is important, because if it is because of something else, then regret may have no effect, right? So it's kind of important to drill down here, right? So we kind of do it in two three different ways, right? First of all, as I said, we could track the actions of the same investors in multiple stocks. Okay, and so what we see is whether regret about decision in Infosys affects my next order about RIL, let's say. Right? And so if that is the case, then at least factors specific to Infosys are not driving this change in decision. Okay, so that's kind of one way in which, and we do find that even if the next order placed is in a different stock, we do see regret impacting that decision as well. Okay. In similar vein, what we do is, if the previous decision was about buying Infosys, okay, and then the next order the investor places is about selling RIL, right? If the decision is driven by overall market trends, whether market is going up or down, then buying and selling decision should be affected differently, right? But there also we find that regret about order to buy Infosys actually affects subsequent decision about an order to sell RIL stock, a different stock, right? So this is also, then what we observe is also not driven by general trends in the market. Okay. Second thing that we do is, then we see if there are specific patterns that are predicted by regret theory that kind of play out in our setting. Okay. And they do, and so that is sort of one more confirmation that this behavior pattern appears to be driven by regret and not general market conditions.
So, Prachi, just to understand, I mean, suppose the decision one was to buy Infosys.
Correct.
And the second decision is to sell Infosys.
Yeah.
That would have constituted regret.
So the first decision was to buy Infosys.
Yes.
Then regret is about the differential outcomes between market order versus limit order for that first decision one, right? And then if there was regret about that decision, then while selling Infosys or even selling RIL, right? If the first decision was market order, and then even in the completely different setting like selling RIL, investors are changing their decisions to different type of order, then we are much more confident that this is driven by regret and not about factors related to Infosys or RIL or whether market is going up or down.
So I have a linked question here.
Yeah.
First is, would you need multiple orders in the second stock to understand this? That's my first question. And second is, I mean, if there is regret indeed, and we measure it in the way you quantified, then how persistent is this regret? Does it continue across subsequent orders, or or does it stop at just the next order?
Yeah. Very, very, very interesting things we find that are answer to your second question. Okay, so let me answer your second question first, and then go back to the first question. Right? So what we find is, right? So here is the broad setting, right? Okay, decision one. To measure regret about decision one, we only need one order, because the comparison is with a different order that would have been placed at the same time. Okay, so then regret about this first decision and then the second decision. So we measure the difference in outcome till the second decision, right? And then we are looking at this second decision to see if it is of a different type than the first decision. And we find that higher the regret, it's more likely that the decision is of different type. Okay. So now this effect lasts only if the second order is on the same day.
Yeah, of course.
And because there is some sort of mental switch reset that happens, and this research in psychology has shown in other contexts also. And even in financial market, experimental research has shown that, right? And so there is a reset button that happens. So even if the second decision is within 24 hours, but on the next trading day, the regret of decision 1 has much smaller, practically negligible effect on decision 2. So the effect is only on for that day. And essentially investors somehow subconsciously realize that it was that this is a temporary thing, that it's an emotional thing. They calm down and are not affected by it as much the next day.
But and my first question there.
Yes.
You will need multiple orders of the second stock?
No. So you will need only one order of the second stock, because all we are saying is compared to the previous order of any stock, whether now the decision of market versus limit has changed. So we don't need to compare it with a different order of the same stock. That is how we have defined like change in a decision compared to any stock's previous order.
Got it. I mean, you did mention an interesting point here that there is regret on that day.
Yeah.
But the next day, we are chastened.
Correct.
Tomorrow is another day. And
exactly. Yeah.
How does regret affect learning then? How does it lead to learning?
Correct. And so, if we step back and, look at our own personal experiences, right? There may be many situations in which, we felt regret about something and like changed the course of our life. And, that turned out to be like a better decision, right? And so, regret can be an emotional basis for learning, because again, in psychology, in neuroscience, sort of many of our kind of rational decisions do have an emotional underpinning, right? And so in that context, regret can be the emotional basis for learning, right? But it can also be the emotional basis for decisions that are kind of not sound. Okay. And so we try to kind of see whether it is really learning versus not, because it could be both, right? You experienced a bad outcome and then you changed your behavior. This could be learning. You are taking one road, one path, and then you are stuck in traffic there for a long time, and then you sort of change your route, and that leads to like less commuting time, right? That is an excellent outcome. So in our case, what we try to do is, if people who have been trading a long time, whether this, what we have documented as the regret effect, right? Whether this effect tapers off as they have trading experience, right? So now learning, we might expect that people who have experience, right, with every new decision, they will not learn as much. I mean, the learning curve is like steep initially. Every like mistake that you make initially, you will learn a lot. But then after a point, you have kind of learned a lot. And so there is additional learning with every new trading decision is small.
You have
right?
a concave function.
Exactly. So we don't find that here. Okay. In fact, we find that people who have more trading experience, if anything, respond slightly more to regret, right? So slightly more is not very much, but still it's not concave function. It does not taper off at all. So that's kind of one indication that it is not learning, right? Second thing that we try to look at, if it is really learning, right, it should improve outcomes for people. And so that is kind of the second part of the paper where we examine how do people's decisions that are impacted by regret, how do they fare, right? So here again, decision one, experience of regret, and then decision two is affected by that regret.
Yeah.
Then we look at what is the profit or loss that people make on decision two, right? And whether based on regret being high or low, whether this profit is actually profit or loss, essentially, right? And so what we find is that decisions that are affected by regret actually do worse. And so in this case, at least this emotional basis leads to bad decisions. And this is kind of another way of confirming that this is not learning.
Okay, so learning here would be you are, consistency in performance, maybe.
Yeah, consistency is performance, at least consistency in performance. It could, if you're really learning to do something better, it should be improvement in performance. And we find the opposite. It's a deterioration in performance.
So this is very interesting. I mean, so regret necessarily does not lead to learning. This is one.
It does not lead to learning and does not lead to better outcomes.
And the more experienced you are, that does not necessarily mean you will not experience regret.
Correct.
Okay. So, I don't know. I mean, just a deviation here. I mean, shouldn't learning and experience make one rational?
Yes, they should. And in many ways, they do, right? So there is other research that has documented learning by individual investors. Okay. And so people do learn, people do get better, right? But that does not mean that they become completely devoid of emotion. That's how I will interpret our results, that even those are still affected by regret, perhaps because regret is such a dominant emotion.
Also, the understanding that, experience is also case of self-realization, and people therefore realize that they should not be making mistakes, perhaps, and that amplifies.
Could be. Yeah. That is a very nice way of putting it. I had not thought about it that way, but yeah, it could be that people feel that, okay, they should not have made any mistake. And the fact that they made a mistake kind of makes them respond more to regret.
This is fascinating stuff.
Yeah.
This is fascinating.
Just, if you don't mind, just I have one question. So,
yes.
So here experience is defined by, during your 1 year sampling period, how many trades you've seen.
Correct.
Whether, obviously I assume the underlying data in terms of whether that particular individual has been trading in the markets for 3 months, 1 year, 5 years.
Yeah.
Underlying data is not available. Okay.
Correct. Yeah. No, you're absolutely right. And that is a limitation. And so we can only say experience to the extent we see them in the sample.
Got it.
Yes.
Okay. If I now take a segue on another sentiment that comes with regret or is conflated with regret.
Yeah.
So a trader experiences disappointment when the trade did not go through his way. Okay. He wanted something, it didn't go through his way.
Right.
And he expresses regret when he sees that an alternative strategy would have given him a higher return, the
Correct.
way we are experiencing.
Correct.
How
Correct.
do we sort of, distinguish between what's regret and what's disappointment?
Yeah. And we kind of, struggled with it a lot, because we, as we were presenting this work, we would get comments that, okay, but, maybe it's just that they're feeling bad, that they made a loss and it's just disappointment. So how do you kind of separate out, right? And so one way we thought about it is, so regret, as I described, is the difference between what happened and what could have happened.
Yes.
Right. Whereas disappointment is simply the loss. If you made a loss, that is disappointment, right? It is not relative to what could have happened. Okay. So we measure, disappointment or happiness, its flip side, just based on whether investor made a positive return or negative return. Okay. And so let me give a more concrete example, right? Yeah. So again, let's say, your first decision was to buy Infosys, right? And using a market order, and the order was executed, and Infosys went up, so you actually made a profit, right? So in this case, you're not disappointed, you are happy. But if you had placed a limit order, and let's say that limit order also would have been executed, your return would have been slightly higher because you could have bought it at a better price.
Okay. Yeah.
Okay.
Fair.
So in this case, there is no disappointment, but there is regret, because if you had placed a different type of order, you could have made a higher profit. So compared to the alternative, your actual outcome is worse. So there is regret. But if you just looked at it by itself, then there is no disappointment. So we in our statistical analysis, we do control for actual return of decision 1, again, so the same time frame till the point of making decision 2. And that has a small effect, but much smaller compared to what we observe for regret, which is essentially the comparison between the two alternatives.
So explain this part a little better. Once more, please.
Yeah. Okay. So again, going back to the example that I said, right? So if it's the disappointment that is affecting the subsequent decisions, right? So in the situation of your buying of Infosys, right, you actually have no disappointment, because your order went up, your price went up, so you made a profit, right? But you could have made even higher profit by placing a different order. So here you have regret. And in this case, if you change your subsequent behavior, then we know that it is not because of disappointment, but it is because of regret. Because there is no disappointment, there's only happiness. But if you're regretting the decision that you made, then you will change your decision. And that is what we find when we kind of compare, statistically compare different situations where there is disappointment versus happiness, and, regret versus not. And so we are able to kind of tease out the effect separately for disappointment and separately for regret.
So, I mean, regret is mathematically sort of measured easy.
Yes.
What did happen versus what could have happened.
Correct.
How do we measure disappointment here?
Disappointment is just what happened.
What happened? That's it.
Yes.
But, sorry to go back. Go back to the other point that you said, that the regret is there. I mean, after one trading day, it just goes away. So effectively, you will have to filter out and strip off the cases where I've made profit, and you have to look at the revised sample in order to arrive at this, because possibly, see, we are trying to distinguish these two here.
Yes.
Perspective.
Right.
I'm just trying to see how this would have worked in real life, because the guy simply would have been happier probably.
Correct. Yeah. So there are kind of two parts to this question, really, right? So one is whether, what we like observe simply, like regret affects subsequent decision, whether that effect itself is driven by disappointment, right? And in statistical sense, we can distinguish by I'm using a little bit technical term here. In a regression, if we include regret and return, which is our measure of disappointment, at the same time, essentially it's a horse race and we see which one wins, right? And the regret wins in that case. Okay. But your second part of your second way of thinking about your question also results in very interesting insights, right? So now, regret theory and experimental work has shown that there may be regret even when the actual outcome was good, right? As in the case of this Infosys buying decision, making profit, right? But this positive outcome actually acts as a little bit buffer against regret. Okay, so the effect of regret is still there, might still be there, but it is muted, exactly as you suggested. And so we also examine it that way. We also see separate out cases where there is regret and there is disappointment, right? So there's a loss and there is regret, whereas there is profit and there is regret.
Yeah.
Okay, and we find that regret has effect in both these situations, but much stronger when there is regret and disappointment. Essentially, if you made a profit, then maybe you won't feel as bad and you won't feel as much regret, and so then you're less likely to change your decision. So in that sense, disappointment versus happiness does play a role. It like sort of amplifies or dampens the effect of regret.
So until now we've been talking about a change in direction of the trade. Okay, somebody goes, somebody buys, and then you see the next trade, and then you basically see the regret.
Right.
What does the magnitude of return have to do with the next trade? So suppose the investor makes some return X% versus 2X%. How does that affect her next trade?
So that is essentially how the magnitude of return is how we have measured like disappointment, right? And the magnitude of return actually does have an effect, right? So if they in fact it turns out that if they made a profit, they are more likely to change their order type, right? But the impact of that, the influence of that variable, the actual return, is much smaller compared to the regret effect.
So I mean, if I consider a scenario where a market is going up, and an investor places a market order to sell, which is immediately executed.
Correct.
The market ultimately actually goes well above that point. And then mean reverts.
Correct.
And then mean reverts.
Correct.
The investor, what will happen? The investor, if he had put a market order, if he had put a limit order, then the limit order would have also been executed.
Right.
But it would have given him a much higher profit because of the the market went up before.
Correct.
So, the change in strategy here between a market order and a limit order is not really affecting. It should not reflect regret. It's basically just price action.
But so this is the thing, right? In our setting, both regret and actual return or disappointment or happiness is all driven by like price action, right? But we are kind of saying that okay, this is the time of decision 2, and what has happened till that point, it's all price action. But in some sense, investor is taking it personally and then changing the decision. And perhaps because of that change in decision is actually a bad decision, And that is why those decisions perform poorly. So essentially, if you're if the investor is kind of tracking the market, right, and they say, oh, if I had placed a limit order, then it would have been much better, right? So it is based on price action, but in some sense, it is the regret is about then timing, when, or at what price I should have placed limit order, or I should have done it this way versus that.
Just a research question here.
Yeah.
So my decision was taken at time T1.
Yeah.
And my measurement starts at T2, because that's when the next order happens.
Correct.
I'm essentially only measuring the difference, my measurement is at T2 and T1.
Correct.
Would it make sense, just thinking here, to understand the max of P between T1 and T2?
Yeah.
And then comparing it with the average of T1 and T2. And if the max is higher, then I've had a concave function, meaning it went up.
In
this case.
Correct.
And if the max is lower, or rather, then it is
correct.
The average is higher.
Yeah.
Would it help sort of understand what was the price direction?
Yes. It can help understand what was the price direction. Two responses to that, right? In our data, we actually do observe the entire price trajectory throughout the day, right? So in that sense, we have used that to kind of identify what happened and what could have happened, right? But another way of thinking about your question is whether regret has kind of more impact when like the market is simply rising, or whether the market has gone up and come down, or whether the market has gone down and come up, and sort of these different types of like price behaviors. Yeah, so that we have not investigated, but yeah, that would be a fascinating question to investigate.
Just some thoughts. I thought.
Yeah, absolutely.
I also then wanted to ask you about. So these are all executed orders that become trades, right? I mean, given orders that become trades, not executed orders. Given orders that become trades.
Correct.
So what if there are orders that don't go through? You give a limit order, and you want to buy, but only at a particular price, and the stock never came down to that level.
Correct.
And so then the regret is only notional.
Yes.
In that sense, right?
Correct.
So I mean, but it should have some impact on learning. Now we've already analyzed how regret leads to learning and experience, but how do you differentiate, because you're looking at orders?
Correct.
Orders that went through and orders that did not become trades.
Yeah. No, excellent question. And because we observe both those, even the orders that remain unexecuted, right? And as you correctly said, that orders that remain unexecuted also have the potential to result in regret, because if buy order that did not get executed and stock went up, then you missed out on that upside, right? And so we are able to calculate regret also on unexecuted order exactly the same way that we calculate on other orders, right? For an unexecuted order, the actual outcome we say is like zero profit.
Yeah.
And compare that to what could have happened, which is a profit or loss. And so we can calculate regret, right? But so regret theory says that, the acts of commission, that is, the actions that you actually take make you feel much more regret than acts of omission, something that you did not do, right? And so this is like our inspiration for looking differently at executed versus unexecuted order. And we do find that unexecuted orders, their regret also affects future decisions, but the impact is muted, right? So it's notional regret, as you correctly said. And so investors don't feel as much pinch about that notional regret. Whereas executed orders, they feel hurt much more, and then their impact on the subsequent decision is much stronger.
This is also, I mean, another sort of, should we understand it as a deviation from rationality? Because to a complete rational individual, there should not be any difference.
Correct. Absolutely. No, you are absolutely right. That if investors are being purely rational, then, what could have happened should matter equally in both cases. But, it does not. And that's kind of in line with prior research in psychology.
Asking a little more sort of, going a little more esoteric here.
Yeah.
How does investor mood affect trading or the regret effect?
Yeah. And so this is, as this is, related to, Mr. Somasundaram's earlier question, whether we kind of reached out to these investors and kind of were able to did a survey to kind of gauge their mood, etc. So no, we haven't done that. The investor IDs are anonymized, but we can gauge their mood based on whether they made a profit or loss. And so we kind of assume that if they made a profit, they're more likely to be in good mood. And then that good mood acts a little bit as a buffer against the influence of regret, and they are less affected by regret. Versus if they made a loss, then they're likely to be in a bad mood, and then regret affects them more.
Another question again on this area. So mood was something more of a temporary phenomenon. But as investors gain experience, they would also have their trading styles. Their particular way of taking risk, their idea of a risk appetite.
Correct.
During that sort of mindset, as it develops over an individual, also allows them to sort of sometimes understand that there is profit and there is sometimes loss.
Correct.
Sometimes there is they do take decisions that are outside of that particular mindset. It's possible. How does that affect regret?
So here, so let's say, Tirthankar, you are a type of investor who generally places market orders. Okay. And then this one time you decided to place a limit order. Okay. And so this is like kind of, deviation from your usual pattern of behavior. Okay. Now, whatever regret you may feel on that one deviant decision affects you much more.
Oh, so if you deviate once, it affects you far more.
And the regret on that will affect your, so let's say decision one, and there's a pattern of behavior before decision one that we can observe from data, right? And if your decision one is different from that pattern, then regret on that decision one will affect decision two far more than if decision one was your usual pattern. In some sense, you're feeling that, oh, why did I change? Because I changed, I had this bad outcome. So let me go back to my usual behavior. So you're much more likely to kind of mean revert to your usual pattern than if the decision one was like the usual pattern of decision.
Just one clarification here.
Yes.
How do we sort of quantify a pattern?
Excellent question. So in our data, again, we can only observe what is in the data. So what we do is either we take, we establish a pattern based on their behavior in the previous month.
Okay.
Or we look at their behavior over the past 10 orders that they have placed. And then, we say, okay, whether, let's say we call market order 1, we call limit order 0, for example, right? And then if we take average over all the orders in the previous month, and let's say that average turns out to be 0.9, essentially that means 90% of the times they placed market order.
Yeah.
Right. And so that is their pattern. And if the next order is a limit order, it's like, very different from their usual pattern. So then that is how we quantify like the usual pattern and deviation from the pattern.
Just more sort of a housekeeping question here. Aren't these decisions affected by liquidity of a particular stock that they are sort of
Yeah, absolutely.
I'd be very happy to, give a market order in a highly sort of liquid stock.
Correct.
We'll be very cautious in a liquid stock.
Absolutely. And so then, what we try to do is we kind of, control for like the stock specific effects using in a statistical way. And so that essentially, we are comparing the change in decision for like one order only like for that stock or even for that stock that day across multiple investors. So to kind of exactly whether the different stocks maybe have different volatility, different liquidity. So essentially kind of filter out all those differences across stocks.
Oh, I mean, yeah. So, one would expect nothing less. One would absolutely expect nothing less. The last question from my side before we, open up for Q&A.
Yeah.
Usually when, decisions are made under regret, how do they eventually, play out in the market? I mean, in terms of returns.
So they actually fare worse than decisions that where regret plays no role.
You answered that. You said that earlier. Yes.
So essentially, it's that is why it's kind of, not learning. It's not good. It's, just emotionally charged decisions.
Wow, some really truly fascinating insights.
Thank you.
Basically, conversion of what one would think as just emotions, sentiment, hardly measurable things, and then quantifying it and putting it in a framework, such an elegant framework, and understanding it. Hats off! This is an amazing.
Thank you. Really. And that's why we enjoyed doing this research kind of much more, and I really enjoy talking about it because everybody can relate to it, right? Everybody has experienced regret one time or another and have like changed their decisions. So even people like, outside finance can kind of relate to it. Definitely people who have trading experience can relate to it. And so thank you so much. I enjoy talking about this as well.
Thank you. Anand, do we have any questions? Yeah, Anand has put up. Yes.
Yes, sir. We do have a couple of questions. At the same time, I have just requested everyone, which I'm repeating again. If you have any questions, please post the same in the Q&A section. We have been tracking that, and we'll also track any other questions which may come. Although we have overshot the duration of our webinar, but we'll keep it going for a couple of more minutes if Professor Prachi does not have any prior engagement.
Oh yes.
Prachi, I can go for about 10 more minutes. So I'll take some questions.
I understand this is a teaching term for Professor Prachi, so I realized we should ask her this.
No, absolutely. Apologies from my side.
No.
Got carried away with.
Me too. I looked at time only after we finished chatting. So it was a very, very engaging discussion. So
yeah, thank you so much, Professor Prachi. Indeed, it was an engaging discussion. Anyway, so let's move on to the question. I think this did get answered once, but I would still like to pose this question again for clarity's sake. The question says, hello ma'am, do you think that trading experience, that is months or years, can affect the degree of regret experienced? Example, regret is higher in those who have recently started trading, or do you see anything like they are learning from this emotion to optimize their decisions?
Again, this is very, very, very important like question of like practical relevance. And as we discussed, we actually don't find that effect of regret tapers off as people gain more experience, right? And again, this is subject to the limitation that Mr. Somasundaran we talked about. right? So based on how we can measure experience, given our data set, that how frequently they have, how much they have traded in our sample, that the more the people trade, they still are affected by regret. If anything, they are affected by regret a little bit more. And Dr. Tirthankar had a very nice explanation for it. Maybe with experience, people feel that I should not make any mistakes. And so if the mistakes they make, they feel more regret towards it, right? So to Muskan answer your question, the experience actually does not diminish the influence of regret.
I think there is another question. Sorry, may I take it, Anand?
Absolutely, sir. Please go ahead.
There's another question from Kunal. He's basically asking, will regret reduce a disposition effect?
So we, excellent question. We did not examine this in our research, but before, people who have studied disposition effect have proposed that regret may actually be the cause for disposition effect. I will not, say much more whether that is actually true or not, because that question we have not answered. But at least the a priori expectation of people working in disposition effect is that regret may enhance rather than reduce disposition effect.
So in other words, if you do experience regret, then you will be much more likely to sell off a losing stock.
Yes, that's, but again, this is not based on our findings, so I can't say, but that is the conjecture.
I mean, it will be something interesting to actually figure out, right?
Yeah.
To see how regret actually leads to measurement of disposition effect. So I think my friend Amol has asked this question. Do you think measurement of regret will differ across countries?
I don't think so. And because I think we have kind of gone to the basics of, what regret really means and derived our measurement idea from that. So I think across different countries, the same idea can apply, right? But what may be different is the market microstructure architecture. And so then what types of orders are possible? Dr. Tirthankar, we were talking about this earlier.
Yes.
And that may change what is like the different possibilities that investors, like, different types of orders that investors can place. So in that sense, those details, might change. But the core idea is that, what actually happened versus what could have happened, that core idea will stay the same.
I think one would also, maybe take a leap and say these behavioral traits should not change much temporally as well, right?
Yeah. And so this people have, like these researchers have documented, right? Like the core tendencies of people kind of generally are observed across different geographies and also across time. So absolutely.
I think there is one more question on this by Mohit. How can this insight be applied to investment advisory?
So yeah, this is a excellent question, because one of the roles of investment advisor is kind of hold investors' hand through like tough times and encourage them to make sound decisions, right? And so we kind of hear about this anecdotally, that when market crashes, investment advisors can reassure the investors, okay, no, now is not the time to sell. In similar way, they can walk investors through and help them reach a calmer place, so to speak, before they make the next decision. And so in this way, they can kind of reduce the impact of regret.
Certainly. I must ask, are there any further questions from the group? Let me just refresh this a little bit. I'm afraid we do not have any further questions. It gives me great pleasure. Today was, I think, we were discussing before the program about like, how do you measure regret? I think first was that question. And then you notice that it has been done in such a beautiful manner. And this entire line of studies, where one was, I mean, personally, I was unaware of this, and how it has been sort of measured in a manner that gives objective answers to what seem prima facie very, very subjective questions. But understanding it and then analyzing this area of investor psychology, I mean, it's a triumph, Dr. Deuskar. It's a pleasure. It's been an actual pleasure. We learned so many things today. So just to, if you allow me to summarize, so Dr. Deuskar and her colleagues, they basically looked at 1 year of data from the Chinese stock markets, and they looked at the retail, investor behavior, all orders of several million investors, and then found out, quantified what is regret. So regret is defined as the difference between what happened and what could have happened, and then went on to provide several insights on that measurement. And they, for instance, explained to us that I have so much notes here that experience, for instance, does not necessarily alleviate regret. You might be experienced, but you will still feel regret. In fact, if anything, you will feel more regret. And tomorrow is always another day, for instance. So even if you take a decision based on regret today, if the impact on regret on a decision tomorrow is much lower, is meaningfully sort of lower. And there is also a nice way they have teased out the difference between regret and disappointment. So Professor Prachi beautifully explained how there are cases where there is disappointment, but not, there is regret, but not necessarily disappointment. So for instance, a stock that went up, and there is regret that you could have bought it. And they also sort of looked at how regret sort of measures between executed trades and unexecuted trades. So there are so many interesting insights from this paper. Professor Prachi Deuskar, I thank you, for this amazing sort of insights, and Somu sir also for pitching in meaningfully at this point.
I also want to thank you. I think it's been a wonderful discussion. I mean, very interesting to hear about this, and thanks so much for that.
Thank you so much, Dr. Tirthankar and Mr. Somasundaram, for very engaging questions and conversation. I enjoyed it very much, and I thank NSE ISB Trading Lab for putting together such an interesting webinar. Thank you so much, Anand.
Yeah, thanks, Anand. Thanks a lot for arranging this. This is really helpful. Thank you.
Always a pleasure, sir. Thank you so much for joining in. Professor Prachi, thank you so much for taking out time during your busy teaching schedule. And Mr. Somasundaram, thank you so much for joining in and chipping in with your questions as well. Wonderful discussion today. I hope that the people who joined in go away with, some more tools against the inherent biases that all of us are born with and trade with. Thank you everyone for joining in, and we'll keep bringing you such interesting and interactive sessions from which you can learn more based on the research that we do at ISB and across the globe. Thank you so much.
Thank you. Thanks everyone.
Thank you. Thank you.
Thank you.
Thank you.